Two recent figures released in Australia shocked me. The first is that Australia's population has surpassed the 27 million mark. In 2023, the population increased by 624,100, a growth rate of 2.4%. This is a new record, considering that over the 30-year period from 1992 to 2022, the average annual population growth rate was only 1.3%. The second is that the average price of a standalone house in Sydney has reached a historic high of $1.6 million. Back in 2010, the average was only $640,000. In just 14 years, the price increased by 2.5 times. During the same period, people's disposable income relative to house prices has fallen further. Sydney is now the second most expensive city globally for housing, with Melbourne ranking 9th. Life in Australia is becoming increasingly difficult. Given the current situation, the economy is expected to continue weakening in the first half of 2024, with a continued negative growth in GDP per capita. So will housing prices collapse? Will the government introduce major initiatives to boost the Australian economy? Why do I believe that the Australian housing market in 2024 will experience an initial slowdown followed by an acceleration, marking the start of the next housing market cycle? My views on the Australian housing market in 2024 might surprise you, seem counterintuitive or even irrational. But once you finish watching this video, you'll have a new perspective and understanding of the market. Hi there, my name is Alex. Welcome to Aus Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Now, how did we get here? To understand the current Australian housing market and predict future trends, we need to turn back the clock and look at Australia's past.
The Australian government saw home ownership as a key to social cohesion as well as economic security.
Like the American dream, the Australian dream represented opportunities and a chance to change one's fate and live a happy life. Back then, you could set foot in Australia with just £10 and a briefcase. Work hard, save money, and eventually own a piece of land and home of your own. Australia offered more opportunities to every dreamer. With hard work and effort, one can enjoy a relaxed and comfortable retirement life. Even if you didn't do well, the comprehensive social security system, pensions, benefits, and healthcare ensures a life of retirement with dignity. But all this is changing.
The stark fact is that, rightly or wrongly, more and more young Australians are seeing that great Australian dream fading away. Mortgage increases, the deposit gap, all are having a psychological impact on our aspirations of home ownership.
In fact, the Australian dream has been gradually fading since that era. In the 1980s, the median price of Australian real estate was only $75,000, which is around $35,000 today when adjusted for inflation. Back then, the average annual salary for full-time working men was $16,000, and for women, it was $12,500. If a family relied solely on the man's income, a house cost about 4.6 times the annual income. For families with only the woman working, it was 5.9 times. But for both working, it took just 2.6 years of combined salaries to afford a house. Considering inflation, Australian housing prices remained stable until around 2000. The first surge occurred from 2000 to 2010, the second from 2010 to 2020, and the third, a massive surge, has been ongoing since 2020. In these 40 years, the ratio of house prices to family income in Australia rose from 2.6 times in 1980 to 8.5 times in 2022, and it's 13.3 times in Sydney by 2024. Fast forward to 2024, the vast majority of Australians believe that the once great Australian dream is dead, and home ownership has become an unattainable dream for the young.
I think it's a lovely dream, but unfortunately, it's looking more and more like just a dream.
A dream,
but that's about it because of the way interest rates are going on there.
Pretty cool to have my own place, because renting and staying in shared houses is not sustainable.
Yeah. Excuse me, son. A lot of families, the husband works 2 jobs, or one works seven days.
Before the 1990s, a formal credit check system was almost non-existent in Australia. Loans were typically agreed upon through a gentleman's agreement and handshake, a system based on mutual trust. The lack of regulation led to the creation of a credit bubble. In the early 1990s, Australia faced a severe economic crisis. 2 of the 4 major banks, Westpac and ANZ, were on the brink of bankruptcy. with Westpac in the worst state. It had an equity of 6.7 billion Australian dollars and assets worth 110 billion, indicating substantial loans but very little equity. From 1992 to 1994, Westpac wrote off bad debts amounting to 5 billion Australian dollars. In layman's terms, Westpac's asset nearly hit zero. If two of the Australian largest banks had collapsed, it would have led to the downfall of the entire Australian financial system. So, in the 1990s, after enduring the economic crisis, Australia's prime goal became economic stability. The focus of lending shifted from high-risk commercial loans to low-risk residential property loans. This shift is why Australia soon experienced a real estate boom, with housing prices rising faster than wages, widening the gap. If people have more money to spend on more expensive houses, they will do so. This is human nature. The pivot of the entire financial system is also why, whenever there are issues in the economy, the government steps in to support the residential property market. This support is crucial for the stability of the economy, credit, financial, and banking systems. A struggling Australian economy has, in recent decades, become intrinsically linked with government efforts to stimulate the housing market. With the Sydney Olympics in 2000, Australia gained more global attention. The same year, Australia introduced the Good and Service Tax (GST) while eliminating several state taxes. This means state and territory government had to find new ways to generate revenue. From 2000 onwards, the cost of goods and services increased by 10% to offset the burden of the GST and ease the backlash and pressure on state and territory governments. The federal government introduced a first home owner grant in 2000, offering a one-time subsidy of $7,000 to home buyers. This subsidy only partially offset the impact of the GST. However, it gave people mental comfort, making them more willing and able to buy more expensive houses, which in turn stimulated construction and related industries. This move boosted the Australian economy and enabled state and territory governments to collect taxes related to property transactions. It was a win-win-win situation. However, the first home owner grant also increased borrowing capacity, magnifying leverage and credit scale, leading to soaring house prices. Seeing the economic stimulation effect, the Howard government in 2001 increased the first home owner grant to $14,000. This further stimulated the construction industry and related sectors to offset the negative impacts of the dot-com bubble burst and 9/11 on the Australian economy. The Australian economy faced only a brief setback and quickly recovered, but house prices continued to soar. In the 2008 global economic crisis, the Australian government again increased the first home owner grant, $14,000 for existing homes and $21,000 for new homes. As expected, the Australian economy was saved and house prices reached new heights. Then, at the beginning of the pandemic, with the Australian economy stagnant, the government introduced a home builder grant offering $25,000 for buying land and building a house. The result was the same. The construction industry and the Australian economy was stimulated, but house prices skyrocketed. In March 2020, the sudden onset of the pandemic swept across the globe. Australia was no exception. To combat the economic impact of the pandemic, Australia started to print lots of money, increasing the total supply of money by 25 to 30%. This was like a stimulant. Everyone felt great when receiving and spending money, but the side effect was inflation, which soared, reaching an alarming level of 7.8%. The prices of various assets skyrocketed. Interestingly, by the first half of 2022, Australia's house prices had also risen by 25 to 30%. With low interest rates at the time, those who chose to buy houses saw their net worth increase. In contrast, those who opted for consumption saw their purchasing power decrease due to inflation and lacked appreciating assets to offset this. As a result, when they eventually decided to buy a house, they found it even more unaffordable, leading to complaints about social injustice. I believe it's not about social injustice, but rather a lack of financial literacy. If one cannot control the urge to consume and invest instead, one's financial soundness can only go one way. From June 2022 to March 2023, due to the rising interest rates, Australia's housing market began to cool, entering a period of decline. However, during the same period, Australia did something to revive its economy. It reopened its borders, allowing immigrants and international students to return. Beginning in February 2022, Australia welcomed back immigrants and international students. Initially, their return had a limited impact on the housing market, but as China ended its lockdown in December 2022, Australia saw a housing market rebound in March 2023. The return of new immigrants and international students directly led to increased rents and house prices. In 2023, the number of new immigrants to Australia exceeded 500,000, a historic high. During the pandemic, the government's home builder grant, first home owner grant, money printing, interest rate cuts, and the introduction of immigrants and international students were all measures to stimulate the demand. Products and services could keep up with demand, but housing supply couldn't increase as fast. The government introduced several plans to stimulate supply, but so far they have been largely ineffective. Australia has only so many construction workers and popular land for building, and it takes years to significantly increase supply. History repeats itself. Australia successfully combats economic crises and maintains financial system stability, but the cost is record high house prices and more young people unable to afford homes. Therefore, government subsidies for residential properties have become the panacea for preserving the Australian economy. Although past subsidies targeted young people, owning a home has shifted from a dream to only a dream for today's youth. Keep in mind the Australian housing market's background. The overall trend and policy continuity are significant bases for my predictions for the housing market in 2024. Forecasting real estate trend is not as simple as it sounds. Everyone has opinions, but not all are worthy of serious consideration. To understand trends, we need to delve into the history and present of the economy, politics, and the system, and examine how similar situations were handled and how people responded. Only then can one make well-reasoned predictions about trends. Australia's economy is currently on a downward trajectory. Although GDP is still marginally rising, it's propped up by new immigrants and the mining sector. Any disturbance could plunge Australia into an economic recession. As I've mentioned in previous episodes, Australia's per capita GDP has already been declining for over 2 consecutive quarters, signifying an ongoing recession. In the first half of 2024, Australia's economy is expected to weaken. So, what will the Australian government do in response? That's right, they will introduce stimulus policies. Apart from the much discussed interest rate cuts, there's another significant move that many might have overlooked: the Australian federal government's Help to Buy scheme. Essentially, it's not much different from the first home owner grant, just under a different name. Its core remains the same, helping those who can't afford homes onto the market by stimulating the residential property sector. How extreme is this policy? If you have 2% deposit, the government contributes 30% to 40% of the equity, which is more like co-investing in a property than a loan, with the rest covered by the bank loans. Do you see what this means? It's offering a leverage of up to 49 times for home buyers, with only a 2% deposit. Currently, our leverage is just 4 times with a 20% deposit. If you have an extra $10,000, you could buy a house worth $50,000 more. Now imagine the deposit dropping from 20% to just 2%. The market is set to go crazy again. More people buying homes means the government essentially joins the property speculation, with banks issuing loans and the construction and related industries being stimulated. History will repeat itself. The Australian economy will be pulled out of the mud, and housing prices will soar to a new level, making homes even less affordable for many. The government's Help to Buy policy is expected to launch around June to July 2024, coinciding with Australia's most challenging economic period, and will be more effective when combined with interest rate cuts. In terms of stimulating demand, we haven't yet considered the government's upcoming third phase of tax cuts. I'll explain this in detail in the webinar. But in short, those earning over $190,000 will buy more new homes for tax deductions, further stimulating the housing market. This is why I believe that Australian housing market will enter a slowdown phase initially this year, but the next boom is not far off. As housing prices skyrocket, greed will grow, accelerating the market rise. Once the economy overheats and credit volume becomes excessive, the government will intervene, tightening the credit and raising interest rates, leading to a market correction. Then economic downturn, government puts stimulus in, and it goes on as a cycle. As long as Australia's economy and political logic remains unchanged, this cyclical pattern in the housing market over the past 2 decades will continue. Every time the economy slumps, the Australian government will find ways to stimulate the residential property market, reviving banks, constructions, and about 18 related industries, pulling Australia out. The result? House prices rise, fewer people can afford homes, and the wealthy gets wealthier, while the rest see their assets shrink. Even thinking of retiring without owning a home, barely surviving on diminishing welfare is terrifying. So to our channel's viewers, don't hesitate. To avoid being hit by stagnant real wages and soaring house prices, Investing correctly in the Australian housing market is your best chance of financial breakthrough and a better life. Some may wonder if this 2-decade market logic will change. My view is that it will change eventually, triggered not by sudden black swan events like wars or shifts in the world order, but rather by great rhino events like banking system crisis. But in the next 20 years, it is entirely possible that nothing significant will happen. Although the inevitable will eventually occur, would you stop going to work and striving to improve your life just because there's a theoretical possibility of a car accident? After all, economic crisis and financial system reforms like those in Australia in the 1990s have only occurred once since World War II. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. Have a good one. This is Alex. Bye.